It happened again, quietly, overnight. Gold prices dropped sharply, not after a major economic announcement, not after a surprise rate decision, not after a geopolitical event that fundamentally changed supply or demand. Instead, the move appeared sudden, technical, almost mechanical. By the time most traders woke up, the damage was already done. Stops had been hit. Leverage had been forced out. Headlines scrambled to explain what happened, offering vague explanations about profit-taking or market volatility. But none of those explanations answer the real question. Why does this keep happening the same way? Gold doesn't collapse randomly. These moves follow a repeatable structure. And once you understand that structure, the sell-off stops looking like a market reaction and starts looking like a system executing exactly as designed. This was not panic. This was not sentiment. This was not fear. This was a rule change. Why gold trades differently than people think? Most people believe gold trades like a commodity, something with physical supply, physical demand, mining constraints, and industrial or monetary usage. And physically, that is true. But price discovery for gold does not happen in the physical market. It happens in the paper market. Gold's global price is set primarily through futures contracts traded on exchanges like CME Group, specifically its metals platform, commonly known as COMEX. These contracts allow enormous exposure to gold with a relatively small amount of capital. That leverage is not a side effect. It is the core feature. Because when price discovery is driven by leveraged paper claims rather than physical delivery, control shifts away from supply and demand and toward rules, margin, and liquidity. And that is where the real mechanism lives. The overnight change. No one explains properly. The sell-off did not begin with selling pressure from physical holders. It began with an overnight change in margin requirements. Margin is the amount of capital traders must post to hold a leveraged futures position. When margin requirements rise, the cost of holding the same position increases instantly. Nothing about gold itself changed. The only thing that changed was the rule. For highly leveraged traders, this creates an immediate problem. They must either post more capital or reduce their positions. Many cannot post more capital quickly, especially overnight, so they sell. That selling pushes prices lower, which triggers stops, margin calls, and forced liquidation across the system. The initial rule change cascades into a full sell-off, even though no fundamental event occurred. This is why these moves always feel sudden and unavoidable. They are not reactions. They are mechanical outcomes. Why margin hikes always hit at the worst possible time. One of the most misunderstood aspects of margin changes is timing. These adjustments almost never happen during calm markets. They occur during periods of rising prices, increasing participation, and growing leverage. That is not accidental. When markets heat up, leverage increases, retail participation rises, momentum traders pile in. This is when the system becomes most sensitive to margin changes. A small increase in required capital produces an outsized effect. The rule change does not create selling pressure out of thin air. It exposes leverage that already exists and forces it to unwind all at once. That is why the move feels violent. It is leverage collapsing, not belief. Why institutions are rarely hurt. The same way, retail traders experience margin hikes as shocks. Institutions experience them as known variables. Large participants structure positions differently. They have deeper capital reserves. They hedge across markets. They anticipate margin adjustments because they understand how exchanges manage volatility. When margin rises, weaker hands are forced out first. Stronger hands absorb liquidity at lower prices. This is not conspiracy. It is structure. The system is designed to protect itself, not individual participants. Why the headlines? Always miss the point. After the sell-off begins, the narrative machine turns on. Analysts scramble to attach explanations. Interest rates, dollar strength, risk-off sentiment, technical resistance. None of these explanations explain timing. They explain direction after the fact. The real cause already happened. It happened in the rulebook, not the news. Margin changes do not make for clean headlines. They sound boring. Technical? Uninteresting. But they're the single most powerful short-term driver in leveraged markets. And they are almost never explained in plain language. Why this keeps repeating? This was not the first time. It will not be the last. Gold and silver have experienced this exact pattern repeatedly over decades. A rally builds, leverage increases, open interest rises, then margin requirements change. The market sells off sharply, confidence collapses, participation drops, the price resets. This is not manipulation in the cartoon sense. No one needs to pick up a phone and order a sell-off. The mechanism does the work automatically. Change the rules, and the outcome follows. Why physical demand does not protect the price. One of the most frustrating realities for long-term gold holders is that strong physical demand does not prevent these sell-offs. Central banks can be buying. Retail demand can be strong. Supply can be constrained. It doesn't matter in the short term. Paper markets dominate price discovery. Physical demand reacts after price moves, not before. When futures prices drop, physical premiums adjust, but the headline price is already set. This is why physical holders often feel disconnected from market action. They are operating in a different layer of the system. What this move was really about. This sell-off was not about gold losing relevance. It was not about inflation expectations collapsing. It was not about confidence in fiat currencies suddenly improving. It was about leverage being flushed. The overnight rule change did exactly what it was designed to do. It reduced risk in the system by forcing weaker positions out. The fact that this also crushed price is not a side effect. It is part of the process. Volatility is controlled not by banning speculation, but by periodically punishing it. Where this leaves the market. After every margin-driven sell-off, the same question emerges. Was this the end of the move, or just a reset? History suggests it is a reset. Once leverage is reduced, volatility falls, the market stabilizes, stronger participants rebuild positions, physical demand reasserts itself. The cycle begins again, but only after enough damage has been done to discourage excess participation. What most people still don't see. The most important takeaway is not about gold itself. It is about how modern markets function. Price is not just a reflection of value. It is a reflection of structure, leverage, and rules. Those rules can change overnight, and when they do, markets move whether participants agree or not. What happens the moment the rule changes? The moment a margin requirement changes, the market enters a different regime. Nothing needs to happen next for price to move. No new sellers need to appear, no news needs to break. The move is already mathematically locked in. Margin defines how much exposure a trader can hold relative to capital. When that requirement rises, the same position suddenly becomes more expensive to maintain. For traders operating near their limits, this creates an immediate imbalance. They are no longer compliant with the new rules. At that point, choice disappears. They must either inject fresh capital or reduce exposure. And because margin changes often take effect quickly, sometimes overnight, capital cannot arrive in time. Positions are closed not because traders want to sell, but because they are required to. This is the first wave of selling, and it is entirely mechanical. Why selling accelerates faster than logic? Once forced selling begins, price drops. That price drop has consequences beyond the original margin change. Many leveraged traders place stop-loss orders beneath key technical levels. Those stops are not opinions, they are instructions. As price falls into those levels, the stops trigger automatically. That selling pushes price lower still, activating more stops, creating a cascading effect. None of this selling reflects a change in belief about gold's long-term value. It reflects the structure of modern trading. At this stage, selling accelerates because systems are reacting to systems. Humans are no longer in control. Algorithms, margin formulas, and risk parameters take over. The move feeds on itself. Why liquidity? Disappears at the worst moment. During these cascades, liquidity evaporates. Market makers widen spreads or step back entirely. Volatility spikes. The order book thins. Small sell orders move price far more than they normally would. This creates the illusion of panic. In reality, it is absence. Liquidity is not constant. It is conditional. And margin events change those conditions instantly. When liquidity disappears, price must fall until buyers reappear. That often means overshooting to the downside, well beyond what fundamentals would justify. Why this always happens? When confidence is high. One of the most revealing aspects of margin-driven sell-offs is timing. They almost always occur when sentiment is improving, when price has been rising steadily, and when participation is increasing. This is not accidental. Rising prices attract leverage. Leverage increases open interest. Open interest increases systemic risk. Exchanges exist to manage that risk, not eliminate it. Margin hikes are a pressure release. They are applied when leverage becomes uncomfortable for the system. From the system's perspective, the sell-off is not a failure. It is a correction. Why physical holders feel blindsided? Every time physical gold holders experience these events as irrational, demand feels strong, supply feels tight. The macro backdrop often supports higher prices. And yet, price collapses anyway. The reason is simple. Physical markets do not control price discovery in the short term. Futures markets do. Physical demand reacts to price. Futures prices dictate it. This is why premiums often rise even as spot prices fall. The two markets are responding to different forces. Understanding this disconnect is critical. Without it, every sell-off feels inexplicable. Why institutions are positioned differently. Large institutions are not immune to margin changes, but they are prepared for them. They operate with diversified collateral, layered hedges, and access to liquidity that smaller participants do not have. They understand that margin changes are part of the cycle. They anticipate them. They reduce exposure ahead of time. They wait for forced selling to create opportunity. This is why ownership quietly transfers during these events. Weak hands exit, strong hands absorb, not through manipulation, through structure. Why the narrative always comes after the move. After the sell-off, explanations flood in. Analysts point to interest rates, currency moves, geopolitical calm, or technical resistance. These explanations are not wrong in isolation. They are incomplete. They explain why gold might struggle broadly. They do not explain why it fell that night. The true cause already occurred. It happened in the margin schedule, not the macro data. But margin does not fit cleanly into a headline, so it is ignored. Why this is a feature, not a flaw. From the exchange's perspective, margin hikes serve a purpose. They reduce leverage. They lower systemic risk. They protect clearinghouses. They ensure the system survives. Price damage is collateral damage. The exchange does not exist to protect price. It exists to ensure settlement. Understanding that distinction changes everything. Why these events reset the market. After the forced selling exhausts itself, something interesting happens. Volatility falls. Open interest declines. Leverage is reduced. The market becomes quieter. This is the reset. Only after that reset can price move sustainably again. Only after excess speculation is removed does the market stabilize. This is why these sell-offs often precede periods of consolidation or renewed accumulation. The system clears itself before moving forward. What most traders learn too late. Most participants learn this lesson after they've been forced out at the worst possible moment. They assume they misread the market, misunderstood sentiment, or ignored some macro signal. In reality, they misunderstood structure. They were correct on direction and wrong on timing. And timing in leveraged markets is dictated by rules more than ideas. Why this will happen again. As long as gold trades in leveraged futures markets, this mechanism will repeat. It does not depend on conspiracies, coordination, or intent. It depends on math. Leverage builds, margin changes, positions unwind, price resets. The pattern is stable because the system is stable. Where this leaves gold going forward. This event does not invalidate gold's long-term role. It does not signal the end of the bull case. It signals that leverage ran too far, too fast. Once the forced selling finishes, the market reverts to fundamentals, but only after enough damage has been done to discourage excess participation. That is the price of operating inside a leveraged system. What understanding the mechanism changes. Once you understand this mechanism, the sell-off stops being frightening. It becomes diagnostic. You stop asking why gold failed and start asking what leverage was flushed. You stop watching headlines and start watching structure. And that changes how you interpret every move that follows. What happens after the forced selling ends? Once the cascade of forced selling exhausts itself, the market enters a very different phase. Volatility contracts. Open interest declines. Price movement slows. The emotional intensity that dominated the sell-off fades almost as quickly as it appeared. This is not because uncertainty has been resolved. It is because leverage has been removed. The market becomes quieter, not because participants feel confident, but because many participants are gone. Positions that could not survive the new margin environment have already been liquidated. What remains is a smaller, more resilient group of holders with lower leverage and longer time horizons. This is the reset the system was designed to produce. Why confidence has to be broken first. One of the least discussed aspects of margin-driven sell-offs is their psychological role. These events do more than reduce leverage. They damage confidence. Rising markets attract belief. Belief attracts participation. Participation attracts leverage. Leverage increases fragility. The only way to reverse that cycle is to shock confidence. A sudden, unexplained sell-off forces participants to question their assumptions. It introduces doubt. It discourages immediate re-entry. Even traders who were correct on the broader trend hesitate to step back in. That hesitation is not accidental. It is essential. Markets cannot move sustainably when everyone believes the same thing with leverage. Confidence must be broken before stability can return. Why the worst selling happens. Near the lows. During margin-driven events, the most aggressive selling often occurs near the end of the move, not the beginning. This confuses observers who expect panic to lead and exhaustion to follow. In reality, the selling intensifies as prices fall because margin pressure increases as equity shrinks. Traders who survive the initial move become vulnerable later. Accounts that were safe at the start of the sell-off become non-compliant as losses accumulate. This creates a second and sometimes third wave of forced liquidation. By the time the selling peaks, the market is often already near exhaustion. That is why bottoms feel chaotic. They are the point where the last forced sellers are removed. Why price? Often rebounds. Without news. After the selling ends, price often stabilizes or rebounds without any obvious catalyst. No major announcement, no policy change, no shift in macro conditions. This confuses those waiting for confirmation. The confirmation already happened. The market changed because its internal structure changed. Leverage was flushed, risk was reduced, selling pressure disappeared. Price moves because pressure is gone, not because optimism returned. Why long-term holders benefit indirectly? Long-term holders who survive these events often feel frustrated by the volatility, but structurally, they benefit from the reset. Excess speculation is removed. The market becomes less crowded. Future moves encounter less resistance from forced liquidation. In this sense, margin-driven sell-offs serve as a clearing process. They delay progress, but they also make it more durable. This is why sustained trends rarely move in straight lines. They advance through damage. Why repeating this process is necessary. As long as gold trades in leveraged paper markets, this process must repeat. Leverage will always rebuild during rallies. Participation will always increase as price rises. Risk will always accumulate invisibly. The system cannot allow leverage to grow indefinitely. Periodic resets are not anomalies, they are maintenance. This is why experienced participants expect these events rather than fear them. They understand that stability without resets is more dangerous than volatility with them. Why retail is always surprised. Retail traders are consistently surprised by these events because they are trained to look for explanations in news, sentiment, and macro narratives. They are not trained to monitor leverage, margin schedules, and exchange risk management. By the time the explanation reaches them, the move is already over. This asymmetry is not malicious. It is structural. Markets reward those who understand mechanics over those who react to narratives. Why this is not about gold alone. This mechanism is not unique to gold. It appears in silver, energy, equity index futures, and any market where leverage plays a central role in price discovery. Gold simply makes the mechanism more visible because its physical narrative often contradicts its paper behavior. That contradiction forces the question, why did price move if nothing changed? The answer is always the same. Structure changed. What this event signals going forward. The key question after a margin-driven sell-off is not whether gold is broken. It is whether the reset is complete. Has open interest fallen enough? Has volatility contracted? Has participation cooled? When those conditions are met, the market becomes capable of moving again without collapsing under its own leverage. Until then, uncertainty remains elevated. Why? Understanding. This changes everything. Once you understand this mechanism, overnight, sell-offs stop feeling random. They become interpretable. You stop searching for hidden news and start watching visible structure. You stop assuming the market is irrational and start recognizing that it is procedural. This does not make trading easy. It makes it honest. Setting up the final conclusion. What happened to gold was not a failure of fundamentals. It was not a rejection of its long-term role. It was the system enforcing its rules. The rule change did not ask for permission. It did not wait for consensus. It simply executed. That is how modern markets operate. The system did exactly what it was designed to do. What happened to gold was not an accident, a glitch, or a failure of the market. It was the system functioning exactly as designed. Modern financial markets are not built to reflect value in a pure sense. They are built to manage risk, liquidity, and settlement at scale. When leverage grows too large, the system does not debate. It intervenes indirectly through rules. Margin changes are not opinions, they are enforcement mechanisms. They exist to protect clearinghouses and exchanges from cascading failures. When risk accumulates, the system tightens conditions until that risk is removed. Price damage is not the objective, but it is accepted as the cost of stability. From the system's perspective, this sell-off was a success. Why this is structural, not situational. Many observers treat events like this as one-offs, caused by unique circumstances or bad timing. That interpretation misses the larger truth. As long as gold price discovery is dominated by leveraged futures markets, this mechanism is permanent. Leverage will always increase during rising markets. Open interest will always grow as participation expands. Risk will always accumulate quietly beneath the surface. And when that risk reaches an uncomfortable level, the rules will change. This is not dependent on who is trading or why they are trading. It is a function of structure. The same inputs will always produce the same outputs. Why complaining about fairness misses the point. After every margin-driven sell-off, frustration follows. Traders complain that the move was unfair, artificial, or disconnected from reality. Physical holders feel betrayed by price action that contradicts supply and demand. Commentators argue about manipulation. But fairness is not a design goal of modern markets. Stability is. The exchange does not exist to ensure participants feel comfortable. It exists to ensure trades settle and the system survives. Any outcome that achieves that goal is acceptable, regardless of who is hurt in the process. Understanding this does not make the system just, it makes it legible. Why price is not the same as value. One of the most important lessons from this event is the difference between price and value. Value changes slowly. Price can change instantly. Price is the result of positioning, leverage, rules, and liquidity at a specific moment in time. Value reflects long-term fundamentals, scarcity and demand. In leveraged markets, price often moves violently while value remains unchanged. This is why gold can sell off sharply without losing its monetary relevance. The price move is not a vote against gold. It is a consequence of leverage being unwound. Confusing the two leads to emotional decisions at the worst possible moments. Why this mechanism? Disciplines participation. These events serve another function that is rarely acknowledged. They discipline participation. They remind traders that leverage is conditional, not permanent. They punish complacency. They reduce overcrowding. After a margin-driven sell-off, participation drops. Retail interest fades. Media attention moves elsewhere. The market becomes quieter. This is not accidental. Markets require periods of discouragement to remain functional. Endless enthusiasm is destabilizing. Pain resets behavior. Why strong hands are built in silence. While confidence is shaken publicly, positioning quietly shifts. Long-term participants rebuild exposure at lower prices. Physical demand often increases. Central banks and institutions that operate without leverage are unaffected by margin rules. The transfer does not make headlines. It does not happen loudly. It happens while attention is elsewhere. This is why the aftermath of these events often looks boring. Boring is where accumulation happens. Why timing matters more than direction. Many participants are correct about gold's long-term trajectory and still lose money. This is because direction without structure is useless. Being right eventually does not help if you are forced out before then. Margin-driven markets punish correct ideas expressed with incorrect timing and leverage. They reward patience, capital discipline, and understanding of mechanics. This is not intuitive, but it is consistent. Why this is the cost of a leveraged system. The benefits of leveraged futures markets are obvious: liquidity, accessibility, efficient price discovery at scale. But those benefits come with a cost. The cost is periodic violence. There's no version of this system that delivers smooth, uninterrupted trends. Stability requires disruption. Risk management requires liquidation. Anyone participating must accept that trade-off. What this event should actually change. The lesson is not to fear gold or abandon it. The lesson is to understand the environment in which it trades. Overnight rule changes are not anomalies. They are tools. Ignoring them does not make them go away. Understanding them does not eliminate risk, but it changes how that risk is interpreted. The market is not random. It is procedural. The final truth about what happened. Gold did not fail. The narrative did. What failed was the assumption that price reflects belief alone. What failed was the idea that fundamentals protect you from structure. What failed was the belief that markets move only when something important happens. Something important did happen. The rules changed. And when rules change in leveraged systems, price has no choice but to follow. This will happen again. Not because gold is weak, not because demand disappears, but because leverage will return, risk will accumulate, and the system will respond the same way it always does. The mechanism does not learn. It does not adapt. It repeats. The only variable is whether participants understand it before it executes again.